In this example, we've got a company with a taxable income before any losses are applied. Let's just go through the requirements for losses. So this is an ATO web page, and it talks about losses from the point of view of when you need to prepare a losses schedule. So forget about the concept, or in this case, the requirement for consolidated group losses. We're not talking about that. This is just purely in case of a company which has losses in its own right, and those losses could be a combination of revenue losses or capital losses. So anytime a company has net capital losses and tax losses, so a combination exceeding 100,000, you need to have a losses schedule. Actually, the Lodgit tax return will actually warn you if you've exceeded this level. It can only deduct a tax loss or apply a net capital loss in the income year or a later income year if the business continuity test is satisfied. So that's typically to do with change of ownership. So we're not going to go through that in any great detail, just assuming you haven't had a change of ownership. So you'll be able to claim your losses. So we'll go through this. We're not going to worry about life insurance companies or controlled foreign corporations. So let's just dive into the losses schedule instructions. Okay, so you could read through this, but let's actually just go straight into the tax return and have a look. So let me move this down so that we've got a cleaner view of this. Losses are over here, and you can see I've said yes, we are required to lodge a losses schedule because we've exceeded that 100,000 combined value. And you can see the tax losses carried forward. So where's that 150,000 coming from? You can see we had a loss there in the 2021 financial year, but that could have been spread out across those years. And you could see, because I haven't applied any losses, we've got to carry forward, and 150,000 will carry forward. So let's just go back and have a look and see how much loss we need to apply to get this down to 0. So we're going to our reconciliation. So you'll have your accounting facts before and after tax. So total accounting income before tax and then less tax. So we still have a profit, and we still have a taxable income after all the adjustments. So we've got some adjustments that are coming through here, other reconciling items, like for instance super payable 30 June 2021 now deductible, super payable 30 June 2022 not deductible because it hasn't been paid by 30 June. Okay, some temporary full expensing adjustments, there's another video on that. Entertainment adjusted and added back, right? So these are non-deductible add backs essentially. And then down here, other income not included in assessable income. So there's a whole lot of things that could constitute adjustments, tax adjustments from the accounting profit down to the taxable income. So let's go back down to that taxable income. So we need 69,145, and we need to put that in here actually. Now we've got 0 taxable income. And let's go back into losses, and we'll apply. So tax losses utilized. Okay, so now we've still got to carry forward, right? So tax losses. Oh, this is wrong. That's incurred. No, we don't have incurred. Subtract tax losses deducted. Right, so those values must match, and then you can see you're still going to have a carry forward on this year. Tax losses carried forward to later income years. And actually, in that case, the losses schedule is quite useful, even if you don't have to lodge it. If you keep it in there, then at least you've got a good record as to how your values arose. So sometimes it's worth just using the losses schedule, even if you don't have to have it by law. Okay, so Now what you can see is that zero taxable income and our tax loss carried forward to future years is different. And of course you'd want to do a verification and make sure there's no errors in this form. This is just a dummy form, so I can't do that for you, but that's essentially how you'd fill a losses schedule.